Okay, welcome to today's webinar. It is a pleasure to have Keith Staats with the Illinois Chamber of Commerce Tax Institute. He's the executive director, and he is here this afternoon to share some information about the graduated income tax constitutional amendment that's on the ballot in what now? We're almost down to single digit numbers now, just a few days. So we wanted to make sure that we provide this opportunity for the business community to receive some very valuable information. We've worked with Keith in the Illinois Chamber of Commerce on a number of initiatives, and they always provide quality information, and it is an honor to be working alongside them on business issues that impact all of you. So I'm going to go ahead and turn off my camera at this time. The webinar is recording, and I'm going to go ahead and turn it over to Keith in just a moment here. And let me get my screen shared. All right, take it away.
Okay, thank you very much. I appreciate the opportunity to speak with everybody this afternoon. Let's go ahead and dive right into the presentation and go to the second slide, the next slide. Okay, there we go. This is the current language in the Constitution. Notice that it says that the income tax has to be at a non-graduated rate, and at any time there can be no more than one income tax imposed by the state for state purposes on individuals and only one tax imposed on corporations. And then the drafters of the Constitution also put in a provision that prevents the General Assembly from amending the law to try to soak corporations by saying that the difference between the rates imposed on corporations and individuals can't exceed an 8-to-5 ratio. In other words, if the individual income tax rate is 5%, the highest corporate rate can only be 8%. And let's go to the next slide, please. There we go. Okay, there we go. This is the language of the proposed constitutional amendment. As you can see, it strikes through the prohibition against a graduated tax. It also strikes through the prohibition against having only one tax imposed by the state. And it just says simply now, it would say if the amendment's adopted, the General Assembly shall provide by law for the rate or rates of any tax on or measured by income. And while it keeps the 8-to-5 ratio between individuals and corporations, it really eliminates the protection that's given by that clause, because it's a ratio between the highest rate on individuals and the highest rate on corporations. So as an example, under the legislation that would be implemented automatically on January 1st, setting new tax rates, if this were to pass, the rate on corporations is supposed to be raised to 7.99%. But as is the highest rate on individuals. So under this new language, this amended language, the General Assembly could go in on January 2nd of next year, and they could raise the rate on corporations to higher than 15% if they wanted to amend the law to do that under this new version of the ratio, which really doesn't provide much protection. Okay, let's move on to the next slide. And now this is the provision of the Constitution that explains what is the requirement. How many votes does the amendment have to get in order to be effective? And it either has to be greater than 50% of the people that vote in the election, or 60% of the people who vote on the constitutional amendment, okay? Now, why is that in there? That was in there because the drafters of the Constitution realized that a lot of times people would skip over constitutional amendments. So they wanted to make sure that there was a high enough bar for enacting amendments amendments to the Constitution. That's why they put in that 60% requirement of those voting on the amendment, or a majority of those voting in the election. That's not really going to be a big issue, I think, in this particular constitutional amendment like it is in some other ones, because this one has been so well publicized, and I think it's one where probably virtually everybody has an opinion one way or another. Okay, let's go to the next slide, please. Again, we can skip that one. I've kind of already gone through everything on this slide. But let's talk about, I want to talk about some of the myths that the proponents of the graduated income tax have out there. And, you know, one of the things you've probably heard many times already is the current flat rate tax is outside of the mainstream. We're different than the majority of the other states. But I want to go through the facts. And facts are this: 43 states in the District of Columbia have individual income taxes, and 41 of those states tax wages and salary income. There are 2 states, New Hampshire and Tennessee, that only tax investment income. And in fact, Tennessee's phasing out their investment income tax at the end of this year, I believe. 7 states don't have a personal income tax. And then 9 states are like, Illinois is one of the 9 states that has a flat rate, single rate tax. Next slide, please. So we've got 32 states in the District of Columbia that have a supposed graduated rate structure, and that's what the proponents say. They say, hey, Illinois will be like the majority of the other states in the country if we just authorize a graduated income tax. Well, let's dig into that a little bit, and you'll see why that's really a misleading statement. 10 of those 32 states that have a graduated income tax begin their top rates at under $25,000 in taxable income for both single filers and joint filers. So, you know, maybe in theory they have a graduated rate, but when they begin at 25,000, you know, really 90% of the people in the state are all being taxed at the same rate. I think Missouri used to be, oh gosh, they may have raised it now, but their top rate used to kick in at like 6,000 or 8,000, I think. But anyway, really a minority of states have a graduated rate structure like the proponents want to put in place in Illinois. The current flat tax is really consistent with how the majority of the states tax individuals. Next slide, please. And then when you go to corporations, it really is even more outside of the mainstream. 13 states, maybe it might be 14, impose a graduated income tax on corporations. And don't forget, even though the implementing legislation that would kick in on January 1, if the Illinois graduated income tax amendment passes, does not currently have a graduated income tax on corporations, the amendment would authorize one. I mean, that's way outside the mainstream. Very few states have a graduated income tax structure for corporations. We're right in the mainstream with that. And, you know, I think it's inevitable if there's authority for a graduated rate on corporations. My guess is that the General Assembly is going to come in and pass legislation to impose some type of a graduated rate structure on corporations as well. Next slide, please. So, I mean, here are the facts. The constitutional amendment and Senate Bill 687, that's the implementing legislation, is only going to give Illinois parity with the minority of the states that have a graduated rate structure that, in my estimation, that's what it does. It punishes the successful. It's not going to give Illinois parity with the majority of the states, many of which tax virtually everybody at the same rate, even if they have a theoretical graduated rate structure. Next slide, please. Okay, second myth. Illinois overtaxes low and middle income families below because we have a flat rate tax. And that's simply not true. There's nothing inherent in a flat rate tax that overtaxes low and middle income families. And to understand that, let's talk about a little bit of the history. The Illinois Income Tax Act was enacted in 1969. At that time, the people that drafted the Illinois Income Tax Act set the standard exemption, the exemption that everybody gets for themselves, their spouse, and their kids, at $1,000. So a married couple with no kids would receive $2,000, and a family of four received $4,000. And to put it in perspective, back in 1969, that was a very good exemption and deduction for dependents. As the federal standard exemption and deduction was only $600 back in 1969. And the legislature didn't amend it until sometime in the 1990s. So if the standard exemption had just been indexed for inflation since 1969, it'd be worth $7,077 today. And a family of four would pay no Illinois income tax on their income, their first $28,308 of income. So, I mean, to the extent that someone wants to argue that Illinois overtaxes low and middle income families, it's not because of the flat rate tax. It's because of the inaction of the Illinois General Assembly and governors of both parties that have been around since 1969. And, you know, another thing that Illinois has done that a lot of states have done, we've piggybacked off the feds, and we have a refundable earned income credit that's right now it's 18% of the federal earned income credit as well. Next slide, please. Okay, this is another myth. The current tax system collects inadequate revenues because of corporate loopholes. This simply isn't true. If you look at the tax base, there are two exemptions that are responsible for most of the reduction of the tax base. On the income tax side, it's the exemption for federally taxed retirement income. On the sales tax side, it's the sales tax exemption for the state portion of food and drugs. Now, I'm not arguing that there's anything wrong with those or that they should be eliminated. What I'm saying is you know, it's a myth that corporate loopholes somehow contribute to the current tax system collecting inadequate revenue. Look at the largest reductions in the corporate income tax. They're the edge credit, which is 82 million versus, you know, 2 billion on the other side for retirement income, and the research and development credit for 34 million. To put things in perspective, right now Illinois collects around $28 billion a year from the personal income tax and about $2 billion from the corporate income tax and about $8 billion in sales tax revenues. These are all numbers that the comptroller compiles every year in a document she calls the tax expenditure report. Let's go to the next slide, please. You know, the proponents talk about a graduated income tax as being a fair tax. I disagree with that. Graduated income tax punishes the successful by taxing a greater percentage of their income. I don't think that's the definition. It's not my definition of fairness. Next slide, please. I think the flat rate tax is really the fair tax. The flat rate tax ensures that everybody pays their fair share of state government. And let's look at some numbers. And we're looking at 2017 numbers because that's the last year that the Illinois Department of Revenue was made publicly available. Back in 2017, there were about 6.2 million returns that were filed by individuals. Those are, you know, single filers and joint returns. And in 2017, taxpayers that had adjusted gross income of $25,000 or less filed almost 1/3 of the total income tax returns. They paid 2.4% of the total state income tax revenues. So, you know, they're low income people. They didn't pay very much of total state revenues. Taxpayers with incomes of between $25,000 and $50,000 filed over 1.2 million, 1.3 million returns that year, and they paid about 8.5% of the total state individual income tax revenues. Let's go to the next slide, please. Okay, there we go. So contrast that with the people in the highest group, taxpayers that have income in excess of 500,000. They filed about 62,000 returns out of 2 million, or 6.2 million, so about 1%. So they were the top 1% of taxpayers. They paid 24% of the total state income tax revenues. So what you have is top 1% pay 24% of revenues. The bottom 50% pay about 11% of revenues. I mean, so, and again, if we go back to the early, we don't have to go back to the slide, but if you think about the earlier slide where I talked about the fact that the General Assembly didn't adjust the standard exemption for many years. The only reason that the lowest income folks pay as much as they do is that it's a stealth income tax increase that's happened to taxpayers due to inflation, because the General Assembly, until really just a few years ago, never indexed the standard exemption for inflation. Okay, let's go forward, please. And one more. Okay, there we go. Flat rate tax, I think, is a fair tax again, because it provides a necessary break on tax increases on individuals. And you know, it does that because everybody at all income levels has to share the pain of a tax rate increase. Governors of both parties and legislators, you know, really find it impossible to keep from adopting new spending programs. I mean, I've been around either doing state taxes now for 30 years, and 10 years before that I worked on staff of the legislature. And, you know, there are always new ideas that come up every year, and a lot of them are good ideas, maybe for additional things that people want government to do. But the problem is paying for it. The flat rate tax really kind of puts a limitation on the ability of the state to raise revenue. So the proponents say that the income tax hasn't often been raised since 1969, and you know, frankly, it hasn't been often raised because it got to be raised on everybody. It's a heck of a lot easier to single out a particular group of, you know, so-called rich taxpayers or particular groups of taxpayers for tax rate increases than it is to raise taxes on everybody. Let's go to the next slide, please. You know, I think the flat rate tax is one of the best economic advantages that Illinois has over its neighboring states. The flat rate tax and that one tax requirement, the fact that the state is limited to imposing one tax, it keeps Illinois lawmakers from singling out particular classes of taxpayers or particular types of income for discriminatory treatment. Let's go forward one more slide. Okay. And I want to talk about that for a little bit, because under the amendment, if the amendment's adopted, the General Assembly can adopt special income taxes on certain groups of taxpayers or certain types of income. So we'll take an example. You know, say the General Assembly decides that they don't like vaping because they think there are health issues associated with vaping. If the amendment passes, they could impose a special surcharge or a special income tax on income from people that are in the business of retailing vaping products. And you know, the proponents are going to say, it's never going to happen. And my response to that is it's already been tried. 3 years ago, there was a bill that was introduced in the Illinois House Bill 3393. There were 22 sponsors for this piece of legislation. Folks decided that they didn't think investment advisors were getting taxed at a high enough rate, so they wanted to impose a special 20% surcharge on the income of investment advisors. And you know, this thing got introduced. It got through the House Revenue Committee before it didn't go anywhere finally when it was on the floor of the House, mainly because I think we were able to convince them that they didn't have authority under the Constitution as it exists today to do a special type of income tax surcharge. They didn't really call it an income tax surcharge, but that's what it was. So like I said, we've already seen these things, and I think it'll make it easier under the amendment to tax special types of income at different rates. They may want to decide they want to tax capital gains at a different rate. So anyway, let's talk about the argument of the proponents that this is going to give a tax cut to 97% of taxpayers. Okay. Again, it's a misleading argument, because I want to give you a couple of examples. And this is from the governor's fair tax calculator, and I've got a link to the website where that is, so you can plug in the numbers. But if you're a single individual, you make $50,000 a year, you have no dependents, you're going to get a $39 a year reduction in your income tax under this legislation that would kick in if the constitutional amendment passes. So it's $1.63 a paycheck if you get paid bi-monthly. If you're a family of four and you have $100,000 of adjusted gross income, you're going to get a $60 a year reduction if you're renting. If you own a home and you pay property taxes of $4,000 a year, which is not unusual, at least up in this part of the state, in Springfield or in northern Illinois, then your increase goes up to $100 a year, because they're slightly increasing the property tax credit as well. So that's $4.17 a paycheck if you're paid bi-monthly. Next slide, please. So I mean, yeah, very literally, there'll be people that will get a decrease, but it's an inconsequential amount, I think, in the scheme of things. It won't even pay for going out to dinner. So this is the legislation that would kick in if the amendment passes. It was passed last year, and it would go into effect, or 2019 it was passed, and it goes into effect automatically if the constitutional amendment is adopted. As I said previously, corporations are going to be taxed at a non-graduated rate so far of 7.99%. So that's going to be a total tax on corporations of 10.49% when you add in the personal property replacement tax. That'll put us either second or third highest in the country. And as I already talked about, the General Assembly would have the authority now to impose graduated rates on corporations. Next slide, please. These are, I won't spend a lot of time with them, but these are how the rates are going to look. The one thing I would note is that for people at the highest category, the income tax isn't graduated. If you get to that highest category, it's taxed on your first dollar of income. It doesn't go through that stair step of 475, 4.9, 4.95, etc. From $1, you get taxed at the highest rate. And next slide. The next slide is the tax rate for joint filers. The one thing I would note is that under the legislation, there is a marriage penalty that kicks in. If you look at the income levels, they're different for joint filers and single filers, and there is a marriage penalty that's imposed here under this proposal. Next slide, please. So anyway, this is summary. I've kind of already gone through pretty much all of that. There is a new child tax credit. That's part of the way they also get to giving everybody, making the argument that 97% of people are going to have a bit of a decrease. Next slide. There is no indexing of the tax brackets. I mean, right now we're obviously in a situation where there's little to no inflation, but that's not going to stay that way forever. So every year there's going to be a stealth income tax increase based on the rate of inflation. And if you're somebody who is a business owner and you operate as a partnership in a subchapter S corporation, you're still going to pay that entity level tax. You're still going to pay the replacement tax at the partnership or S corp level. and then you're still going to be subject to the higher rates on your income that flows through to you at the individual level. So you're going to get whacked harder than in some ways than people that are getting wages. Next slide, please. So how did they raise the money? They went to these 62,000 taxpayers out of about 6.2 million. That's in corporations. That's pretty much all where all the additional money is going to come from. These numbers are for a full year, a full tax year. So this would be what they would bring in for calendar year 2021. You would increase taxes on individuals about 3.7 million. Corporations go up to 332 million. And it's designed to raise new revenues of 3.4 billion on an annual basis. Next slide, please. Again, talked about this a little bit. The corporate rate will be the third highest in the country, only behind Iowa and New Jersey. And Iowa's is actually scheduled to decline, so it will be number 2 after that happens. Pass-through income would be at the 4th highest rate after California, Oregon, and Minnesota. And next slide, please. Again, I think the proponents are taking the easy way out on this. I think it's easier to propose amending the Constitution to authorize a graduated income tax to tax a small minority of people that are successful than to really do what I think Springfield needs to do, which is to conduct a detailed review of the current tax system, evaluate the efficiency and the efficacy of the items that have contributed to base erosion under everything, under income tax, property tax, and sales tax, and to look at spending. But that's a lot more difficult than I think what they have done, which is proposing the constitutional amendment and saying, don't worry about it. We're just going to tax rich people. Next slide, please. So it comes down to trust. I mean, do you trust Springfield to not continue to raise taxes, not continue to let the increases creep down to the lower income levels? I don't. My experience in Springfield is I don't trust that that'll happen. And think about how they're presenting this. They're presenting the argument in favor of the graduated income taxes is trust us. We'll but that's just the opposite of the argument that was made in 2016 when the Safe Roads Amendment, the Lockbox Amendment, was passed. If you remember, that was the amendment that said that you had to use road funds for road purposes. The General Assembly couldn't raid a road fund to use it for other purposes. And it passed overwhelmingly. And why did it pass? People didn't trust politicians. They didn't trust the General Assembly to do things wisely. Now the argument is, hey, trust us. Next slide, please. And really, that's pretty much everything that I had in the presentation today. We've got a resource center out there on our website. Please help us get the word out on our opposition to the graduated income tax. I'm happy to answer any questions anybody has too.
All right, thank you very much for that, Keith. That was a great presentation, and I think really, I appreciate that you have boiled down a really complex issue to just a few slides. That makes it a lot easier to understand, and I know that's appreciated. So this clearly, if passed, is going to place Illinois at an even greater competitive disadvantage from a business perspective, and I think that's awful. Can you share with us maybe what has happened? What's the forecast? From other states that have passed a graduated income tax, what have we seen in those states as far as business impact?
That's a good question, and I mean, one of the states you can look to is what happened in Connecticut. Connecticut, I think, was one of the last states that passed a graduated income tax. and they did it. And as their taxes evolved over the years, they've added additional brackets. They've continued to increase rates. Contrast that with Kentucky, who had a graduated income tax, and they went to a flat rate tax. They did just the opposite. I can tell you from my experience, before I joined the chamber, I was with an accounting firm and a law firm before that. And we would, in a lot of occasions, we'd have companies come to us and we'd say, hey, we're trying to decide where to either locate a headquarters, expand our business. And one of the important components of the analysis that we would put together for folks was the tax climate. Even under the current system, Illinois doesn't have a great tax climate because of the fact we have very high property tax rates. We have high sales tax rates. One of the things that we did have going for us, or do have going for us now, I should say, is the fact that we have a relatively low flat rate income tax on individuals. And we had, well, it isn't the lowest tax rate, we at least had a flat rate tax on corporations. If this amendment goes into effect, we're going to lose that. The Tax Foundation just recently came out with an analysis of, they do a ranking every year of the states, and we're, from 1 to 50 in terms of the tax climate. I think we are somewhere right now in the 30s. And the reason, again, we're in the 30s is because of our flat rate income tax. If the graduated income tax is enacted along with the legislation that's designed to kick in automatically on January 1, that ranking goes down to 45, 47. It puts us in there with New York, New Jersey, and California among the worst states for an overall tax climate.
So thank you for that explanation, Keith. I've heard a lot about the possibility of this opening the door to tax retirement income. Of course, those who are in favor of passing the graduated income tax argue that that's not in the amendment, but could you explain why that is such a concern?
Yeah, it's not in the amendment, but what it does is it would make it easier for the General Assembly to tax retirement income. I mean, under the current flat rate tax, if they decided to tax retirement income, they have to tax everybody, okay? They can't say we're only going to tax income of more than X number of dollars. If the graduated income tax amendment is adopted, and it opens the door for the General Assembly to be able to come in and say, we think anybody who has, and pick out a number, say $100,000 or more in retirement income should get taxed. Or we think that maybe pension income and Social Security income is okay, and we won't tax that. But we're going to tax everybody when they withdraw money from their 401ks or 457 plans. It just makes it easier for them to open the door to taxation of particular types and particular levels of retirement income. Right now, the General Assembly is afraid of trying to tax retirement income because it's going to hit everybody at all income levels. If they don't have to do that, they can make the same arguments with respect to retirement income that they're making right now with ordinary income and saying, hey, don't worry about it. We're only going to tax this one group of rich folks.
And I believe that has been at least uttered by a couple of folks in Springfield, right?
Yeah, I think the treasurer made the mistake of admitting that
Yeah.
when he was on some kind of a program with my boss.
Yeah, that was an accident, right?
It was a little too honest for his own good.
Yeah, exactly. So you did mention that there was a state, and I don't remember which state it was, but this has actually been undone. So if this does pass, I'm sure that the process is pretty cumbersome, but it would be possible to get it back on the ballot and undo it.
Yeah, you could. I mean, it'd have to be another constitutional amendment. I can't remember offhand if Kentucky had to do it by constitutional amendment, or if their legislature just came in and said, hey, we're just going to change the structure to go to a flat rate. But
Okay.
yeah, we don't want to go there if we don't have to, because it would be, I think it's one of those things that it'd be difficult to undo if it gets done.
Sure. So could you talk about competitiveness? We're always concerned about our positioning among our neighboring states. And of course, here in this area, we are about a 20-minute drive from Missouri, or even shorter in some cases. So just kind of the overall tax environment with our neighboring states.
Yeah, I mean, it certainly makes us less competitive. Missouri, like I said, has in theory a graduated income tax structure, but its top rate kicks in at a very low rate. And anybody who's owned property in Missouri knows that the property tax rates are substantially less in the state of Missouri than they are here. So I think this would definitely make us even less competitive with companies that are trying to decide, do I put something on the Metro East side, or do I put something over the Missouri side? It's just another thing that goes into that calculation that I was talking about before, when businesses are trying to decide where to locate or relocate, and it makes it a lot less favorable for the state of Illinois.
Sure.
Same thing going to the other side of the state when you look at Indiana, that has its own flat rate tax structure, and you factor in other things like workers' comp insurance costs and things like that, and it really makes the case for Illinois a lot more difficult.
It sure does. And, the last thing that we want, of course, is for our job creators to pick up and go somewhere where the environment and the opportunities are just more business friendly. So I have one last statement and then a question. To me, this is clearly an example of, yet another example of the state of Illinois going to taxpayers rather than doing the real reforms that I think we in the business community know need to happen. So my last question for you is, does Illinois have a revenue problem or a spending problem? Or both?
Well, prior to the pandemic, Illinois had natural revenue growth of about $500 million a year. Okay, so every year we were getting in additional revenues. The big problem we have in Illinois is we've got a General Assembly and governor of both parties. I'm not, that don't have any fiscal discipline. Let me give you an example from the recent past. 2 or 3 years ago, there was a big push to revise the education funding formula because, as you know, there was a push in Springfield to revise that formula to get more state revenues dedicated to local school districts. The theory being that if we did that at some point, the local districts could lower their property taxes because they'd be getting more money from the state. And so we went through this long involved process in Springfield of drafting and adopting legislative funding reform legislation. And it was designed to require the state to kick in, I think, somewhere around $500 million a year in additional revenues that would be dedicated to local school districts. Okay, and that sounds great in theory, but the problem with it is the legislature did what the legislature always does, is they put in this new program and they put in this new requirement of additional state spending, but they didn't come up with a mechanism to pay for it. So They just put it in and said, okay, we got to figure out how to come up with 500 million every year. And that's been the problem, I think, as much as anything in Springfield. So I guess if you want to characterize it, it's more of a spending problem in that sense. Now, I mean, there are a lot of good programs that need to be funded properly, but that's kind of my prime example of the ways that Springfield will decide that they have fixed a problem without really fixing it.
Right. I think that's a common theme for us, unfortunately. All right. Well, if there is anything else you'd like to add, Keith, go ahead. And otherwise, I think we can go ahead and wrap up, and I will make sure that we get this very informative video shared out to all of our businesses.
Great. And if anybody has any questions, I'm more than happy to, my emails on the PowerPoint.
Okay.
Give me a call or shoot me an email. Happy to answer anything.
Okay, wonderful. Well, I appreciate how accessible you are, and thank you very much for spending this, it's pretty dreary here, this dreary Friday afternoon with us on the computer. So I look forward to seeing you in person, hopefully in the near future, and have a wonderful weekend, and thank you very much again.
Thank you. Thanks.
All right, bye, Keith.